Hello class, welcome to week 6, the final week of class. This week we're going to be talking about partnership taxation. We'll start today with chapter 9 on partnership formation and operation. So in forming a partnership, you just need 2 or more people to come together and contribute either property or money into the partnership entity to get the business started. And you can divide it up any way you want. It can be 50-50, it can be 30-70, 60-40, however you agree with your partner. But each would contribute something into the partnership. There are 2 types of partnerships, general and limited. A general partnership, in that type of partnership, each partner can make binding decisions for the entity. They also have unlimited liability for the partnership debts, and they can potentially lose their personal assets, so they can be sued personally for the business. So if you think about this, if you have a partner and they can make binding decisions for the entity, and you have unlimited liability for the partnership debts, you better really trust that person, because they could go out and take out a big loan and you're liable for it. With a limited partnership, they have to have at least 1 general partner and 1 limited partner. The limited partner can potentially lose only up to their investment plus any committed amounts. So if you have a limited partnership and you're the limited partner, you have some protection under the law. The general partner, however, is liable for the partnership debts. But there would be limits then, too, on the decisions that the limited partner could make. Therefore, you wouldn't have the risk that you have with the general partner, where you would be liable for the partnership debts. There are a couple different types of limited partnerships. You have a limited liability limited partnership, or LLLP. Also, limited liability companies are treated as partnerships for tax purposes, and they have the limited liability of a corporation. And the tax treatment is based on check the box. So you have to apply for your tax treatment, what type of tax treatment you want. Limited liability partnerships, LLPs, these are similar to LLCs. And so just like with the S corporation, the income, the deductions, and the tax attributes, these are allocated to the partners and then passed through to the partners. So first they're divvied up between the partners. Each takes their fair share, their percentage, their agreed upon percentage, and then it passes through to their personal tax return. And so one of the things that you have to do with a partnership is to calculate the partnership's basis, typically once a year or anytime any major change happens. So you would start with the partnership contribution, which would be cash or property or both, and their share of the partnership debt. And then you would add or minus the partnership's share of the partnership operations. So you would add any income or any increase in debt, and you would subtract their losses and any payoff debt. And then you would get your ending partnership basis. And so periodically you have to go through and calculate that and keep track of each partner's basis in the business. So let's look at an example. Here, Tom buys a 20% interest in XY partnership for $8,000 on January 1 and materially participates. XY partnership has $2,000 in liabilities. The following year, XY takes on $4,000 in additional debt and a $10,000 loss. So to calculate the partnership basis, we're calculating Tom's basis. His contribution was $8,000. His share of the debt $2,000 plus $4,000 times 20%. This gives you $1,200. His share of the loss, 20% times 10,000. You'll subtract that loss, the $2,000. And so his ending basis is $7,200. So there you have it. That's just a brief introduction into partnership taxation. You'll read much more about this topic this week. I'm going to post a question in the discussion board for everyone to answer. Good luck. I hope you enjoy the week. Good luck on your exam this week, and good luck in your future endeavors.